describe the classifications of assets and markets. There are 5 major classes of assets that candidates need to be aware of: securities, currencies, contracts, commodities, and lastly, real assets. Each of these assets have unique characteristics and trade in a variety of different markets that candidates should know. We will discuss the varying types of markets here first, before moving on to the distinguishing characteristics and examples of each asset. Financial markets are classified as either money markets or capital markets. Money markets trade debt instruments, in which the securities mature in 1 year or less. Examples of securities that trade in money markets include repurchase agreements, certificates of deposit, or commercial paper. Capital markets trade instruments of longer duration, including long-term bonds and equities. The value of bonds is directly tied to the creditworthiness of the issuer and to future interest payments, while the value of equities is typically tied to future dividends. Corporations typically finance their operations in the capital markets. Securities markets include both public markets, such as stocks that trade on the New York Stock Exchange, and private markets, in which securities are negotiated privately. Public market securities are generally liquid, but also require issuers to meet certain regulatory requirements before securities can be issued to investors. In private markets, securities are typically illiquid, and only qualified investors can participate. However, as compared to public markets, private markets do not face the same regulatory scrutiny. In addition to public and private markets, it is also important to distinguish between primary markets and secondary markets. Securities that are sold in the primary markets are sold directly to investors, such as in an initial public offering of stock. Money flows directly from investors to the issuer. In secondary markets, traders buy and sell stock from each other, and, consequently, money flows between traders, as is typical throughout the trading day on any major public exchange. One major dividing line in categorizing contracts can be set in terms of their delivery date. Contracts that are set to be delivered in the future are said to trade in the forward or futures market. Contracts that are set to be delivered immediately are said to trade in the spot market. Traditional investment markets include all publicly traded debt and equity securities, and pooled investment vehicles that own public securities. Alternative investment markets include hedge funds, private equity and venture capital funds, commodities, real estate securities, securitized debts, operating leases, machinery, collectibles, and gems. Alternative markets are generally characterized by assets that are harder to value and much less liquid, making them more difficult to trade.